Hello everyone, and welcome to Financial Accounting. In this video, we're going to look at the demonstration problem for the chapter Basic Financial Statements. We will look at balances in assets, liabilities, and owner's equity accounts, and learn how to use the accounting equation to calculate missing balances. We will also look at how to decide whether a company has a strong financial position by looking at the company's financial statements. If you haven't had a chance to watch the video Basic Financial Statements, I'm posting the link right here and in the description box of this video. For the instructions for this demonstration problem, we need to do the following. Prepare a balance sheet as of September 30th, 2021. Briefly explain whether this balance sheet indicates that the company is in the strong financial position. Decide how would an income statement and a statement of cash flows allow you to better respond to Part B. In the previous video, we looked at the balance sheet of a travel agency. Before we move on, let's review what the balance sheet is. The balance sheet is one of the major financial statements that shows the company's financial position. It shows the resources of a business and the claims against those resources. In other words, the balance sheet shows the company's total assets and how these assets are financed, for example, through debt or equity. The fundamental part of accounting and the most basic equation in accounting is the balance sheet equation or the accounting equation. Assets equal liabilities plus owner's equity. It forms the base for a double entry accounting system. We will learn more about the accounting equation in future videos. Take a look at the example on the screen. The balance sheet has three major sections: assets, liabilities, and owner's equity. In our example on the screen, we have total assets equal to 300,000 and total liabilities plus owner's equity also equals 300,000. We will use the accounting equation to solve for retained earnings in our demonstration problem. Let's start working on the problem. The first step is to decide whether an account belongs to assets, liabilities, or owner's equity. Assets are probable future economic benefits obtained by a particular entity as a result of past transactions or events. Accounts receivable is an asset account. We sell customers on account and will collect cash from them in the future. The building is an asset account as we are going to use it in the future for many years. The cash account is an asset account. We will be using it for future purchases. The land account is an asset account as we are going to use it for many years. The machinery and equipment account is also the asset account. Same as with building and land, we are going to use machinery and equipment to produce revenue. The supplies account is an asset account and shows how much supply we have on hand. Liabilities are probable sacrifices of economic benefits arising from the present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. For example, accounts payable means that you will be paying for goods received when an invoice becomes due. Unearned revenue means that you will be providing services to your customers for which they prepaid. Accounts payable is a liability account. When we buy from vendors on account or on credit, we receive goods first and have to make a payment later when it becomes due. The notes payable is a liability account. We sign the note promising to pay a certain amount of money at a particular time. The salaries payable account is a liability account and shows how much money we owe to employees for their services. Owner's equity is a residual interest in the assets of an entity that remains after deducting its liabilities. In a business enterprise, equity is the ownership interest. For example, if revenues are higher than expenses, net income can be reinvested in the business or distributed to the owners or shareholders. The capital stock account is the owner's equity account and shows how much shareholders invested in the company. The retained earnings account is an owner's equity account. It shows how much of net income is accumulated to be retained for reinvestment in a business rather than being paid out in dividends to stockholders. After you decide which account belongs to assets and which belongs to liabilities and owner's equity, it's time to put together a balance sheet. If you're unsure about some accounts, I have a sample chart of accounts posted on my website. See the link in the description box of this video. Here is our balance sheet. All asset accounts are grouped together and have a total. The liabilities and owner's equity accounts are also grouped together and have a total. The only account that doesn't have a balance is the retained earnings account. Remember that you must have the name of the company, the name of the financial statement, and the date or dates of the statement in the header of the balance sheet. The balance sheet is issued as of a specific date. The income statement and the statement of cash flows are issued for a particular period of time. Our sample balance sheet is as of September 30th, 2021. How is it going so far? If you like this video, please click on the like button so I know what you think. We know all balances in the asset accounts. We also know that assets are equal to liabilities plus owner's equity. Let's add all asset balances together. The total is $234,480. Total liabilities are $55,200. The capital stock is $120,000. Now let's calculate the balance in the retained earnings account. We know that liabilities plus owner's equity is $234,480, the same as total assets. You can calculate the balance in the retained earnings account by subtracting $55,200 and $120,000 from $234,480. To have a better visual example, let's plug all balances we gathered so far into the accounting equation and then solve it for retained earnings. The assets, $234,480, are equal to total liabilities, which is $55,200, plus owner's equity, which includes capital stock of $120,000 and retained earnings. Now we solve the equation for retained earnings by moving all amounts from the right side of the equation to the left side. Don't forget to change the sign when you move the numbers to the opposite side of the equation. The balance in the retained earnings account is $59,280. Congratulations on solving the first part of the problem. Now let's finalize our balance sheet by including the balance in the retained earnings account. When working with the balance sheet, it is always a good idea to double-check whether your accounting equation balances. Make sure your total assets are equal to total liabilities plus owner's equity. The next step is to decide whether the balance sheet shows that the company is in a strong financial position. To answer this question, we need to look at liquid assets and compare them with liabilities. The balance sheet shows that Crystal Auto Wash is in a weak financial position. The only liquid assets, cash and receivables, total only $12,000, but the company has $55,200 in liabilities due in the near future. Now let's look at part C of the assignment. The question we have to answer is as follows. How would an income statement and a statement of cash flows allow you to better respond to part B? Investors are very interested in the company's profitability. You can learn about profitability from the income statement. Creditors are interested in a company's liquidity or the ability to pay its debts as they come due. Liquidity is critical to the survival of any business. A business that is not liquid may be forced into bankruptcy by the creditors. As we already know, net income is part of retained earnings, which are in turn part of owner's equity. Therefore, we can say that profitable operations increase the value of owner's equity. When a company keeps operating unprofitably, it means they have net losses. It will eventually exhaust its resources and will have to close the doors. Therefore, users of financial statements want to see the financial statements, particularly the income statement, to try to predict what is going to happen with the business in the future based on prior year's results. If we could see an income statement for Crystal Auto Wash, we could have seen the company's revenues and expenses for the period ending on the date of the balance sheet, September 30th, 2021. We only know the amount of retained earnings, which is the difference between revenue, expenses, and dividends, if any. We know that the balance in the retained earnings account is $59,280. It could be $10 million in revenue, less $9,940,720 in expenses. It also could be $100,000 of revenue, less $40,720 in expenses. We will ignore dividends for now. You see the point. It is hard to determine the amount of revenue if we don't have access to the income statement. The information on the income statement would be helpful in determining whether the company is successful in selling its auto wash services at an amount that exceeds its cost of providing those services, something the company must do to remain in business and be successful. The statement of cash flows for the same period as the income statement would show where the company's cash came from and where it went in terms of its operating, investing, and financing activities. This information would be particularly helpful in assessing the strength of the company's ability to satisfy its obligations as they come due in light of the relatively weak balance sheet. That's all for today. Thank you for watching this video. Don't forget to like and subscribe so you don't miss future videos. I will see you soon.